BY in a situation, a two-sector economy where there's no government intervention. But when there's government intervention, you have C equals A plus BYD. C equals consumption, A equals autonomous consumption. Autonomous consumption, like I explained earlier, has to do with consumption. No matter what happens, you will still spend. You have those who are not working, who don't have a means of income, but they still spend. Those set of people, that is what is called autonomous consumption. Consumption that arises irrespective of if you don't earn any income. You also have BYD. B equals MPC, marginal propensity to consume. Marginal propensity to consume. YD equals disposable income. I'm going to explain MPC as we go further. So I already explained that disposable income is income minus your tax, all right? The formula for MPC has to do with what is marginal propensity to consume. It has to do with change in consumption as a result of your change in disposable income. So it has to do with, as your disposable income increases, the additional unit you can consume, the additional unit of your disposable income. For example, if your income increases by a marginal of, let's say, $1 or $2, with that marginal change, how much can you consume? So as your disposable income increases by $1, $2, $5, $6, look at that marginal change. As that changes occur, what happens? Your consumption increases. So what can you consume as a result of a change, a marginal change in your disposable income? Okay? So MPC has to do with the change in consumption as a result of your change in disposable income. Change in consumption all over change in disposable income. Average propensity to consume. This is another concept of consumption. It is a fraction of the disposable income that is consumed. All right? So out of your disposable income, how much are you able to spend out of what you can spend? You don't spend all your resources. For example, let's say you have a disposable income of $10,000. Out of that, $10,000 can go to savings. And while out of that $10,000 can go to maybe every other thing you want to spend. So the amount that you spend out of your disposable income is referred to as average propensity to consume. Okay, so oh no, this is chapter 3. This is chapter 3. So let's go straight to. So the average propensity to consume is consumption over disposable income. Take note of your formulas. So I'm in slide 13. Slide 13 shows your the graph. All right. It shows the graph. So on the x-axis, you have okay, so you have consumption. You have consumption and disposable income. So on your y-axis, what do you have? You have consumption. On your x-axis, you have disposable income. All right. So I already explained your marginal propensity to consume, which is explained by the equation B, is the change in consumption all over change in disposable income. All right. That line shows you can have A is autonomous consumption. All right. The consumption that you take irrespective of what you earn. So that line equals the consumption line equals A plus BYD. Autonomous consumption plus B. The B is refers to MPC and YD is disposable income. So let's go to 14. Now, let's go to the savings function, savings function and the MPC. And the MPS. That is an MPS. So individual households can use their disposable income in two ways. So I said your disposable income can come in two ways. One, for the purchase of goods and services, and for savings. So your disposable income is either you spend it or you save it. All right. It doesn't mean you have to spend all your disposable income. All right. Savings is a fraction of disposable income which is not spent or consumed in the current period. More precisely, savings is the difference between disposable income and consumption expenditures. All right. Savings is a fraction of disposable income that is not spent on consumption. What is the formula of your savings? It's disposable income minus consumption. So what you have left is your savings is your disposable income minus your consumption. Now, what is your savings function? Savings function is minus A plus 1 minus B into bracket disposable income. The savings function shows the relationship between planned saving and disposable income. Savings is positively related to disposable income. It is positively related to disposable income. So positive relation simply means that, you know, if they increase your income today, what happens? You have the ability to spend more, and you also have the ability to also put some money aside for yourself. All right? You have the ability to spend more and to also put some money aside for yourself. So take note of that. Savings is positively related to disposable income. That's another theory for you. You need to find out. For example, in Jordan, is the savings, individual savings in your economy, if you go and check, look at the data, is it related to their disposable income? All right, is it related? So the savings function, marginal propensity to save. Marginal propensity to save is the function of the additional income that will be saved. All right, so as your income increases, like I explained, you have every tendency to be able to increase your savings. So let's say your income increases by $10. Out of that $10, what is your marginal propensity to save? So you have a tendency to save a portion out of that $10 that your income has been increased by. So MPS is changing savings all over changing disposable income. So as your disposable income increases, as it changes, your disposable income, your savings also increases. So if your disposable income falls, what happens? Your savings also falls. It goes in both ways. It goes in both positive relationship. So you can see the graph in 16, the savings function. You can see that. You can look at that too. The graph. The slope of the savings function is 1 minus B or MPS. Remember, for consumption function, the slope is B. All right. But for the savings function, your slope is 1 minus b. You must remember that your marginal propensity to consume and your marginal propensity to save must equals 1. Your marginal propensity to consume and your marginal propensity to save must equals 1. So your last slide, the last slide is the point you must take note in this chapter. You can refresh it as you get to your PhD, all right? The point you must take note in this chapter is, number one, the foundational perspective of the classical theory of income and employment is that supply will create its own demand. Supply will create its own demand. On the other hand, Keynes' theory states that demand comes before supply, all right? He proves the classicalists wrong by saying the assumption does not apply to the macro or aggregate economy at large, which I also explained before. 3, Keynes assumed that consumption is directly and linearly related to disposable income. Take note of that. Direct relationship between consumption and disposable income. A direct relationship between consumption and disposable income. Aggregate demand is also known as aggregate expenditure, all right? Aggregate demand is also known as aggregate expenditure. Consumption is the largest component of the aggregate demand function, all right? Consumption is the largest component of the aggregate demand function. Saving is positively related to disposable income. Savings is positively related to disposable income. And MPC and MPS must add up to 1. All right, so that is the end of this module, the explanation of the slides I sent to you. Take note of the slide, read it properly. If you have any question at all right, as regards MPC, MPS, classical theory of income and full employment, the Keynesian theory of income and full employment, feel free. You can also record a video to explain or to ask your questions, and we can also do a live discussion, all right? A live discussion, a live class together where I'm going to come up. I'm going to find a way to come up live, and we can take a course together, and I'm going to teach you live, and you can ask your questions, all right? So let me know if you have any questions. Have a wonderful day. Bye.